Hello, good evening. Welcome to another show of Smart Money Moves. I am your host, Tiffany Tippins, and today we are going to be doing our second installment of life insurance. Why is it so important to have it? Why is it important to our community, and why it is important to our families? If you don't know, September is Life Insurance Awareness Month. And all month I have been talking about, all month I will be talking about and have been talking about life insurance and the different phases of it, how to get it, when the best time to get the coverage, what you need to be looking for in a particular policy, whether it's term insurance or permanent insurance. And I explained that last week. I'm going to pick up on variable universal life. Last week we talked about term insurance, whole life, and universal life. But today we are going to be talking about variable universal life insurance and how we can create that as a LIRP. So you may ask, what is a LIRP? A LIRP is a life insurance retirement plan. And so within a life insurance policy with the variable universal, you have a portion of it that can be used for cash value or savings. But before I go into what type of life insurance is a variable universal life insurance, I just want to kind of reiterate my story of why life insurance is so important to me and why I'm in this business. As I had mentioned last week, and I do have another show here in the Dallas area. I am located in downtown Dallas, 1910 Pacific Street, Suite 14140. If you want to come and visit my office, or you can always contact me at 800-408-8850. I also have a show here live on the air every Tuesdays. Now we've moved from Saturdays to Tuesdays at 1 o'clock on Heaven 97, which is the only gospel station here in the Dallas Fort Worth area. And so now, starting September 6th, which is Tuesday, I'm going to be on every Tuesdays at 1 p.m. with Dr. Robert Ashley. Same show, same great topics, just a different time and day. But again, I wanted to reiterate my story why life insurance is so important. And I mentioned last week, I became the recipient or the receiver on the other side of the check, with someone who was receiving the check at the age of 13. I mentioned last week my father passed away at 39 in his sleep. Saw him on a Sunday at church, and the next day, Monday, March 13th, 1989, he was no longer here with us. At the time, my mom and my father were divorced, and it was just, well, it wasn't just me and my brother, but from his first marriage, it was me and my brother. And then my father got remarried. He had only been remarried about a year and a half. Had a new wife, new baby. She was only 1 year old, and a baby on the way. And passed away throughout the night. And lo and behold, he's leaving 4 children behind. Did he have life insurance? Yes, he did. But he did not have enough for the four of us at the time. Just think about it. My brother, we're 4.5 years apart. He was 18, had just enlisted in the Army. I was 13. He had a 1 year old and another baby that was born a month after his funeral. And so it's not just enough to have life insurance, but you want to make sure that you have enough in place to protect your family when you leave this world. You also want to have uh, make sure that who you're leaving your beneficiaries to, because as I mentioned before and on the show yesterday, it wasn't that my father didn't have insurance. He never changed his beneficiaries. He got remarried. probably excited about his new bride, excited about his new addition to our family, and another one coming. That just so much was going on that he never changed his beneficiary. So chaos and conflict erupted immediately. My father had named me and my brother as beneficiary on his life insurance policy, but never changed it for his new family. So they didn't see any of the proceeds, and it was a lot of conflict after that. So I want to continue to urge people, especially in our community, definitely purchase life insurance. The younger you are, the cheaper it is, uh, because life insurance is based on your age and your health condition. So for those millennials out there, folks just getting out of school or in school, if you're fairly healthy and you're young, that's the best time to get life insurance. And when we talk about the variable life insurance plan, probably more younger people would want to get this plan as well. The other thing you want to think about as well is who you're leaving it to. Unlike my father, he never changed his beneficiaries. And I've seen it time after time. We're working with various clients and employees where they don't change their beneficiary and they either leave it to an ex-spouse, they leave it to minor children, and for many states, if your child is under the age of majority, some states is 18, some states is 21, but if they are under that age, they will not receive the proceeds. So it's something to think about as we get into our busy season of benefit enrollments, starting from September until the end of the year, that you want to think about maybe updating or changing your beneficiaries. Um, and so you don't have to do that at any particular time. You can do that anytime throughout the year. That is something that is not restricted by an open enrollment or eligibility time frame. If you have life insurance through your job, you can definitely contact your HR department and make those changes, especially if you have minor children. Know that the funeral home cannot help you if you bring them a policy and you have minor children on it, because any state in these United States will not release any funds to anyone who's under the age of 18. Something to think about. So how can we purchase life insurance? We can purchase life insurance three ways. We can purchase life insurance directly from the insurance companies, whether that's MetLife, Prudential, New York Life, whoever you decide to go with. You can purchase life insurance through your employer. Sometimes that is the least expensive way to do it, especially if you're purchasing a term policy. Most employers don't sell permanent insurance, so you're going to need to purchase that outside of your employer. But many employers will sell term policies where the rates renew every 3 to 5 years or whenever they change a carrier. Generally, your employer will give you life insurance. So it's generally one times your annual salary. But when we talk about and we think about how much to leave, experts say you want to definitely have about 7 times your annual salary. And that depends on you. That depends on, in the event you pass away, how will your family be able to make it financially? Do you have younger kids that you will want to take care of? Their living expenses until they turn 18 or age of majority? Or do you also want to pay for their college expenses as well? That's some things you want to think about. You want the house paid off? Do you want to supplement for the mortgage if you are married? Just know that your income counts. So if you're not here, that spouse is going to suffer tremendously, or your children are going to suffer tremendously because that loss of income has occurred. If you are single, a lot of people ask me, Do I need life insurance? Absolutely, because we all live in different places versus where we grew up. So, for instance, I'm not a native of Dallas, but I'm here, and so if something happened to me, I would not want to be buried here. My body would have to be shipped back to where I grew up, so that costs money. It costs money for a flight to ship my body. It would cost money for preparation with the funeral home. I think a lot of people don't think about that when they're purchasing life insurance, or if they're single, what other costs or final expenses beyond funeral costs would they have to incur? Would I be leaving any other debts behind? Or guess what? Who would have to come out here, clean out my home, and distribute my assets? So even after the funeral is over, and I know this is a difficult subject to broach, but even after the funeral is over, life goes on. But someone has to take care of the person who passed away. They have to take care of their assets, and so I can't expect people to stop doing what they're doing and they're missing income from their job or their business in order to take care of mine. I need to think about the person who would have to do that and who I'm appointing to do that, to fly out here and distribute my assets as if I wanted them, and what is directed in my will. So those are a lot of things that we need to think about. So singles, yes, you do need life insurance. How much you need, how you want to be buried, whether you want to be cremated or you want to have a traditional funeral, that is up to you. But it is no longer where 10,000 is the magic number where people get life insurance. Generally, it's either 50 or more. So those are a lot of things that you want to consider. Again, I am doing life insurance policy reviews all month long at no cost. If you want me to review your policy, definitely give me a call, 800-408-8850. You can also email me at info@impactfulsolutionsgroup.com. That's info@impactfulsolutionsgroup.com. I'm also on social media. I'm on Facebook at Impactful Wealth Solutions. I have a business page there. I am also on Twitter at Miss MS Money Savvy, SAVVY. And I'm also on LinkedIn at Tiffany Tippins Financial Planner. So let's dive right in. I want to go back to a presentation. I want to go ahead and share my screen if I can, and opened up this presentation. There we go. All right. So we are sharing my screen. Until we do that, you see this awesome quote that I have on my screen, and we're going to jump into variable life insurance. Here we go. That's not what I want to do. Okay, well, last week we talked about term and universal. I'm going to start with universal because it involves variable universal life as well. And so with life insurance, you have, again, term insurance designated for a period of time, 5, 10, 20, 30 years generally is the longest time you can get life insurance for most policies. And when that term is up, your policy increases. So, for instance, if you are 25 years old and you get a 30-year policy and you live past 55, at the age of 56, their premium is going to be reevaluated. Why? Because you have outlived the term. You got a 30-year policy, a 30-year term policy at 25 years old. You live past 55, 20 plus 25 plus 30 is 55. And so now at 56, your policy generally quadruples because you are closer to the mortality rate. Now, you can definitely renew it, but most people cannot afford the premium at that time. Term is what I describe is just like renting a house or renting an apartment. You rent during that duration, and at the end of your lease, the landlord can definitely choose to increase your rent. And generally, that's what happens on an annual basis. The premium that you pay, you don't invest any of that dollars. You're just paying for the policy in the event of your death, just like auto insurance. You pay for auto insurance if you get an accident. Great. If you don't, you're protected. Or if you do, you're protected. And the auto insurance company will pay you out based on the liability of the accident. Same like term life insurance. However, with universal and variable universal life and whole life, a portion of your premium, as you can see, goes into the cash value. So unlike whole life insurance, there is no flexible premium or adjustable benefit. With whole life insurance, the premium is fixed and so is the death benefit. So if you purchase a $50,000 policy and your payment is $70 a month, you cannot increase the 50,000 or decrease the 50,000 throughout the life of the policy or as long as you have the policy, nor does your premium increase. So you may want to think of whole life insurance as a fixed permanent policy versus universal and variable universal. As you can see here, the premium is flexible and so is the death benefit. It's adjustable. So for instance, if you purchased a $50,000 policy and you had a child or you got married or life changed and now you need more insurance, you can increase that 50,000 to 100,000. You can do the same in reverse. With that 50,000, let's say you're at age 65, you're now in retirement, you've had the policy for a while, you have some cash value in the policy, you can decrease that death benefit to 30,000. It really depends on the minimum limit within the policy that you can take it down. But the thing that I want to get across and the point that I want to get across is with universal life insurance and variable universal, you can take the premium up or down. It also, a portion of your premium goes into cash value. With universal life insurance, you're going to have a portion of your cash value going into investments that is selected by the insurance company. So they will select the investments for you. And generally that interest rate that you're going to get on that investment is anywhere between 2 and 4%. On an average, I've seen it at 3%. And so you would be accumulating cash value along the way as you continue to pay your premium. What I've seen with people do as well with universal life insurance, they use the premium to either in later years when they're on a fixed income to pay for the cost of the insurance. Now, variable universal life is a little bit different. Works the same as universal life, except that the insurance company does not invest the money for you. They don't invest that premium for you. They can't promise you the 2 to 3 or 4%. You choose that. And so that's why we call it a LIRP, a life insurance retirement plan. Because with the variable universal life, you can invest in sub accounts, and we know those sub accounts to be mutual funds. And so, again, a portion of your premium is going to the cost of the insurance on the left side where you see the certificate, but the other portion is going to the investment sub accounts. So you might see MetLife investments in there. You might see T. Rowe Price. You might see Charles Schwab. You might see Oppenheimer funds. You may see a variable options in there of mutual funds that you can choose from. Because the risk lies on you and you choose the investment accounts, your return is based on market performance. So based on the funds that you select, they can range from very conservative to very aggressive. That's where your return is going to come from. I have this policy. I really like this policy because you can do a lot of things from it, and it's very, very good for highly compensated employees. So people who make six figures, who cannot always maximize their retirement plans. This is an investment strategy that I use with a lot of my clients on putting money in a variable life insurance policy. Why? Because it works just like a Roth IRA, except you do not have the age requirement. So how does it work? When someone can max out on their retirement plan at work, and let's say I'm working with a doctor or a business owner, and they make $275,000. Well, they can only put a maximum of $18,000 in their retirement plan at work. If a business owner had a SEP or simple account, with a SEP account, they could only put a maximum of 25% of their income into a retirement plan. So that's around $53,000 if they made $265,000. So this is still putting them, even if they maxed out that $53,000, they made $265,000. They're still in a six-figure salary over $200,000. They cannot put money in a Roth IRA. Anyone can put money in an IRA, but the max they can put this year is $5,500. Or if they're over the age of 50, they can put up to $6,000. But that still leaves them money where they can put away and withdraw at a later date. This is the policy that they generally can do that. Why? You can put money into a life insurance plan up until it becomes a MEC, or a modified endowment contract. And so with this, let's say they can put an additional $7,000 in this policy in the investment sub account. Remember I said it worked like an IRA? Works just like that, because you have investments that you can invest in this account. However, the difference is when you take this money out of the variable life insurance plan, one, you don't have to be age 59 and a half. So for somebody who's done fairly well in their career, they want to retire early, they have a couple of challenges with tapping into their 401k or their IRA accounts, because they have to be 59 and a half, or they're going to receive a penalty on their taxes. With this particular account, there's no age restrictions because it is not a qualified retirement plan. But I mentioned it's a LIRP, it's a life insurance retirement account, and so, or retirement plan. So with this account, you can pull out no more than what you contributed. So for instance, if you paid $33,000, let's say over 20 years, you paid $33,000 of premiums. However, your investments grew to $53,000. That 33,000 is not taxed. Why? Because that was a portion of your premium. But the 23,000 that grew in the account based on the interest that the investments received, that account is taxed. So the 23,000 that you pull out, excuse me for that, the 23,000 that you pull out this account is going to be taxed. Hey, that's better than the total 53,000 that you pull out of or that you've acquired into the account. So I use a lot of good strategies with the variable life insurance account. It's always a great strategy. Again, especially for younger people who can get more life insurance, and of course for older people who want to invest more than they're putting in their life insurance account. They can pull this money out and be less than age 59 and a half. There's no penalties to it, and you can use the money for what you want to. Does not need to be secured or specifically for retirement planning. It could be a wedding. It could be to invest in your business. It could be to buy a new car, go on vacation, or just supplement your income in retirement. This is exactly why I like the variable life insurance policy. And so what's the difference between, again, the fixed and variable? The fixed is no investment flexibility, fixed return on your cash value. That is the whole life that we talked about. So you can't increase or decrease the death amount, nor can you increase or decrease your premium. It's giving you a fixed return on the whole life and a fixed return on the universal life. With variable, you have investment flexibility. It's up to you how often you want to rebalance your investments. Your variable return is based on the accounts or the sub accounts that you select, which are the investments into the account. Potential for higher returns. Again, I have this policy. I've had this type of policy for 11 years now, and I know that it definitely brought me more than 3 to 4%. So I'm getting returns just like as if I was investing in the market with an IRA or in my retirement plan. And that is based off of the aggressive investments that I chose. But as I said, there's the risk of lower returns as well, depending on which type of investments that you choose. Remember, we cannot guarantee performance based on past returns. So anytime I talk about investments with someone, we have to look at what the investments have done over the last 5, 10, 20, 30 years and project what the market is doing now. Accessing the cash value. You can do this a number of ways, and I just went over this with a client of mine. So accessing the cash value, here is saying withdrawals of earnings are fully taxable at ordinary income tax. So with this policy, yes, you will be taxed on the interest of the earnings. It does say here if you are under age 59 and a half when you make a withdrawal, you may be subject to surrender charges and assessed at 10% federally income tax penalty. For most cash value variable life insurance plans, you are not assessed that penalty. How do I know? Because I just did it on my policy to invest back in my business. So you can take a loan on this policy, or you can just take a withdrawal from the policy. Taking a loan it's just like taking a loan from a 401k or a 403b from your retirement plan. But the interest rate that you're assessed, you do get a loan administrative fee that you're assessed, but you're basically paying yourself back into the policy. Or you can just take the amount that you take out the policy off from the top of your death benefit. So, for instance, if you have a $250,000 policy and you have $50,000 of cash value, you can basically just take that $50,000 out. It will not let the policy lapse. However, your policy will go down to 20 or to 200,000 instead of the 250 because you're taking the 50 off the top. I really like the option for cash value because it provides a living benefit, and we know through life that people they have sometimes they have financial problems through life, and you never know what is going to happen. And working with retirement plans for now over 17 years, I've seen where people are always taking along on their retirement plan, but this you can take it off the top. It's not considered a loan. It's considered a withdrawal if you are reducing the death benefit. Or you can just take that 50 and use it to continue to pay your premiums as well. So there's a variety of ways that you can assess the cash value. The 59 and a half, I want to clarify if you make that withdrawal, if it is a qualified plan purchased for a business, and it depends on the pre-tax status. Only if it's pre-tax will you be assessed at 59 and a half. Generally, life insurance policies, as I stated, you can purchase through your employer or you can purchase outside of your job. Generally, when you purchase through your employer, some policies are pre-tax. So if you're paying pre-tax, your premiums are paid pre-tax, that's when you're possibly assessed at 59 and a half age. But most people pay their premiums after tax because variable universal lives are unlikely to be offered through your job. So plan for the unexpected. Again, this is why I do what I do, because my father didn't plan for the unexpected. At 39 and a half, I'm sure he didn't know that that was going to be the time that he was going to leave this world with 4 children. So you definitely want to plan for the unexpected. And like I said, a lot of times we don't like to have these conversations, but it's a necessary conversation, and it's an important one to have to make sure, guess what, if you passed away or when you pass away, you just want to make sure that you're not the one where somebody's raising money for your funeral or doing a GoFundMe. If you're in good health, you definitely want to look into life insurance. And with your good health, you can definitely go through underwriting. But guess what? If you are not in the best health, you can still get life insurance. There are what we call final expense policies that have no medical underwriting. And no medical underwriting means that you're not being asked any medical questions, nor do you have to go through a medical exam. Some of those policies can be a little bit more expensive, but it still covers you in the event of your death. No one says that you have to have $1 million policy. Get what you can afford. And again, I am here for you at 800-408-8850. One thing I do want to kind of hit up on before I close out the show today. I always say this, especially when you change jobs. That's generally when people do not have any insurance. And I'm going to tell you of a time when I lived in the Maryland area and worked for a very reputable hospital in the area. Worked in benefits. Again, that's how I started my career. For most of you who don't know, working with retirement plans and health and wellness benefits. And for most of you who do know, when you leave a job, generally your benefits leave with you. And it depends on the employer. It depends if someone leaves at the end of the month, or if they leave generally in the middle of the month, their benefits end at the end of the month. But in this particular situation, this young lady, she got a new job. She had worked at the hospital for several years, and she terminated her job on a Friday. We saw her when we gave her all her benefit paperwork when she left, and it was the end of the month. I believe it was the 31st on that Friday. That Saturday, she went out to party in the city, and to celebrate her getting her new job, and there was a police chase in the city 2-3 o'clock in the morning, and the police were chasing a suspect in a car. There was a crash that happened, and that young lady was involved and lost her life. We found out on that Monday what happened, and her family came up to the hospital where she worked to check on her life insurance. She had no life insurance because guess what? Her benefits ended on that Friday, the 31st. The first was on that Saturday. This is again why it's so important to make sure you have life insurance outside of your job, because a lot of times people are in transition, and we need to make sure that we protect ourselves. Some people say, you know what, it's a fluke that it happened, of kind of how the days were. But again, you just never know when you are called home. And this young lady had 4 children. They had no money to bury her because she had no life insurance. So this is why I do what I do. Not only because I was a 13-year-old on the other side of the check receiving funds from my father's death when he passed away, but because I've seen countless times again where people pass away and they don't have any insurance, and particularly that is in our community. And so because our community, and I'm a part of our community, is more sensitive to me, that I educate people on why we need it. You can't tell me her family or even my family would have benefited from the unexpected costs from dealing with a loss of death. A lot of times we're already suffering from that person who's being gone, let alone you have to incur a huge financial expense, and you have to do it quickly within 7 days in preparing for funeral expenses. So again, I leave you with, if you need life insurance or you want your policy reviewed during the month of September, and anytime, but specifically during the month of September, definitely give me a call, 800-408-8850, 800-408-8850. This has been another great show of Smart Money Moves. I hope this is encouraging someone to make some changes in preparing or changing your beneficiaries, making sure you increase your policy, or making sure that you get a quote for a new policy. Purchasing life insurance is a selfless act, and I'm sure those who depend on you after you're gone would truly appreciate it. Thank you for tuning in, and have a safe and blessed Labor Day weekend.